April 25th, 2026. Execution over rhetoric. Why Malaysia's next growth phase depends on institutional delivery. Malaysia's central challenge in 2026 is not instability, but execution credibility. The economy is not short of signals. Growth remains resilient. The ringgit is supported. Investment approvals are at record levels, and trade momentum is intact. Malaysia must prove whether its institutions can convert promising numbers into outcomes that strengthen public trust, investor confidence, and competitiveness. Markets have moved beyond rewarding announcements. They now price delivery. A country can publish strong investment figures and still lose momentum if land is not ready, utilities are delayed, permits move slowly, or labor is insufficient. Malaysia's 426.7 billion in approved 2025 investments is impressive, involving 8,390 projects and more than 240,000 expected jobs. Yet the decisive question is not approval, but realization. The dividend will come when factories are commissioned, supply chains are operational, workers are trained, and exports rise from capacity rather than ambition. The macroeconomic base gives Malaysia room to act. The advance estimate of 5.3% growth in the first quarter of 2026, following 6.3% in the previous quarter, shows resilience in services, manufacturing, and construction. Inflation at 1.7% in March and unemployment at 2.9% in February indicate stability. Industrial production and manufacturing output remain positive. These are not crisis indicators. They are evidence of a platform from which policymakers should pursue structural delivery. Bank Negara Malaysia's decision to keep the overnight policy rate at 2.75% reinforces stability. Monetary predictability is valuable when global conditions remain unsettled. Reserves of 𝙬𝚊𝚘𝚑 128.8 billion as at April 15th, covering 4.7 months of imports and 0.9 times short-term external debt, provide a buffer. But monetary stability is not a growth strategy. It buys time. It does not build industrial depth. Malaysia's next growth phase must come from productivity, investment conversion, technology adoption, and coordination between federal agencies, state governments, regulators, and industry. The ringgit's position below 4.0 against the US dollar is constructive, but it carries discipline. A stronger currency helps contain imported inflation and improves confidence in Malaysian assets. It also reduces the cushion enjoyed by exporters through exchange rate weakness. Companies must increasingly compete through automation, quality, delivery reliability, and higher value production. This is uncomfortable for weaker firms, but healthy for the economy. Malaysia cannot depend permanently on a cheap currency. Trade figures reinforce the same lesson. External trade rose strongly in February and March, supported by resilient demand and supply chain activity. Yet volume alone is not enough. The quality of trade matters. Capital and intermediate imports must translate into productivity gains, export upgrading, and wage growth. If imported machinery sits idle, projects are delayed, or firms cannot secure skilled workers, trade numbers will produce weaker multipliers. Governance credibility is the other pillar of execution. The King's indication that he will choose the next MACC chief as Tan Sri Azam Baki's contract approaches expiry places anti-corruption credibility under attention. The appointment process will be watched not merely as an administrative decision, but as a test of institutional confidence. Investors and citizens alike want enforcement bodies to be independent, professional, and insulated from political sensitivity. Governance optics now carry economic consequences. The failed March attempt to pass a 10-year limit on the Prime Minister's tenure remains relevant. Reform intent was visible, but legislative closure was absent. A reform narrative becomes valuable only when it survives procedure, negotiation, drafting, and voting. Otherwise, it remains aspiration rather than outcome. Fuel subsidies present the most difficult execution tests. Rising subsidy pressure cannot be ignored, but sudden removal would risk backlash and cost of living anxiety. The correct path is targeted reform that protects vulnerable groups while reducing leakage. Subsidy rationalization succeeds only if people believe the system is fair and savings are redeployed responsibly. Bursa Malaysia's selective confidence reflects this broader mood. Investors are not blindly enthusiastic. They are rewarding earnings visibility, balance sheet strength, and governance clarity. That is healthy. It means Malaysia is being assessed not as a vulnerability story, but as a credibility story. The opportunity matters. Malaysia has a firm macro base, investment interest, resilient trade, and a supported currency. But the advantage will not sustain itself. Execution must now become the national discipline. If institutions deliver reforms, manage subsidies responsibly, preserve governance confidence, and convert approved capital into output, Malaysia can turn stability into strategic advantage. Thank you all for tuning in and supporting my podcast news channel. Your time, attention, and engagement truly mean a great deal. I sincerely appreciate your continued support and thoughtful viewership. Join, follow, like, and share.